This is a super tanker. It is longer than the Eiffel Tower is tall, carrying 2 million barrels of crude oil, and it costs $100 million to build. You would think the global economy would do whatever it takes to keep ships like this moving, especially through the world's most critical energy corridor. But here's a secret. In the first week of March 2026, traffic through that corridor collapsed by over 80%, and the entire global oil system started choking. Right now, dozens of supertankers are sitting at anchor off the coast of the United Arab Emirates, going nowhere. So why would the owners of ships worth $100 million each choose to park them rather than sail? And what happens to the world economy when the tap that supplies 20% of global oil just stops? To understand this, we have to start with an uncomfortable truth about energy shipping that almost nobody talks about. Take a look at a map of the Middle East. Between the southern tip of Iran and the northern coast of Oman, there is a gap in the coastline so small it barely registers. The Strait of Hormuz. At its narrowest navigable point, it is just 21 miles wide, and the actual shipping lanes are 2 miles wide each, separated by a 2-mile buffer zone. That's it. 2 miles of open water in each direction through which the world moves its energy. On a normal day, around 138 commercial vessels pass through those lanes. Crude tankers, liquefied natural gas carriers, product tankers, an endless procession of floating warehouses keeping the lights on from Tokyo to Berlin. In total, roughly 20 to 21 million barrels of oil and petroleum pass through Hormuz every single day. That's around 20% of global oil consumption and more than 1/4 of all seaborne oil trade on Earth. Every 5th barrel of oil your economy burns almost certainly came through that 2-mile lane. But here is where it gets complicated. There is almost no alternative. Saudi Arabia and the UAE have pipelines that can bypass Hormuz, but together they max out at around 5 to 7 million barrels per day. That leaves more than 13 million barrels per day with nowhere to go if the strait shuts down. The world simply has no plan B at that scale. So when missiles started flying in March 2026, the global shipping industry did not just get nervous. It froze. Here's what most people don't know about how global shipping actually works. It doesn't stop because of navies. It doesn't stop because of sanctions. It stops because of a phone call from a building in London. Marine war risk insurance is a niche, almost invisible corner of the financial world, and it quietly controls whether any commercial vessel enters a war zone. Every ship that sails into a high-risk area needs war risk coverage renewed every 7 days. Without it, no bank will finance the cargo, no port will accept the vessel, and no owner will send a $100 million ship into a missile corridor unprotected. Before the March 2026 escalation, war risk premiums for Persian Gulf transits were sitting at around 0.25% of a ship's hull value per voyage. For a VLCC worth $100 million, that is $250,000 per trip. Expensive but manageable. Then the attacks began. Within 48 hours of the first strikes on commercial vessels, leading marine insurers canceled war risk cover for the Persian Gulf entirely. Others that stayed in the market repriced fast. Premiums jumped to 1 to 1.5% of hull value. That same voyage for a very large crude carrier now costs $1.5 to $3 million in insurance alone. Round trip, renewed every 7 days. The math kind of makes the decision for ship owners. Every dollar spent on that premium is just gone, and that is before you factor in the very real possibility that your $100 million vessel does not come back at all. So, they anchored. Dozens of very large crude carriers parked off Fujairah and outside the Gulf, engines idling and waiting, and the oil stopped moving. But the financial accounting is just the appetizer. The main course is what that does to the price of everything else. When tanker traffic through Hormuz dropped by over 80%, oil markets reacted within hours. Brent crude jumped more than 10% in a single session, breaking above $82 per barrel. In the days that followed, intraday prices touched close to $120 per barrel, before easing back as markets priced in possible strategic reserve releases. Analysts at major banks started publishing notes with titles like "Sky is the limit." Now here is the interesting part. This is not just a problem for oil markets. It bleeds directly into container shipping, the system that moves your phone, your clothes, your furniture. Bunker fuel, the heavy oil that powers cargo ships, is priced off crude. When crude spikes 20 to 30%, fuel costs for a container ship on the Asia-Europe run jump by hundreds of thousands of dollars per voyage. Shipping lines do not absorb that. They pass it on. Emergency surcharges of $2,000 to $4,000 per container started appearing on Middle East-linked trade lanes within days of the crisis escalating. And then there is the inflation question. Economists and central bank watchers were already on edge before March 2026. A sustained disruption to Hormuz, they warned, could shave 1.5 to 3 percentage points off GDP growth in major oil-importing economies. Japan, South Korea, India, and China together receive somewhere between 10 and 14 million barrels per day through Hormuz. For those economies, this is not an abstract risk. It is a direct hit to industrial output, transport costs, and consumer prices, the classic ingredients for stagflation. But here is what most people do not know, and what changed the entire character of this crisis. In early March 2026, a crude oil tanker flying a Chinese flag was struck by an Iranian missile in the Persian Gulf. Not a Houthi drone drifting off course, not a warning shot across the bow, a direct hit on a vessel carrying oil to the single largest buyer of Iranian crude on Earth. China purchases well over 5 million barrels per day through Hormuz. It has quietly kept Iranian oil exports alive through years of Western sanctions by buying discounted crude through a shadow fleet of tankers operating just outside international oversight. You would think Iran would treat Chinese vessels as untouchable, and here is why that assumption matters. When Tehran struck a Chinese tanker, it sent a message that no flag, no relationship, and no economic dependency would guarantee safe passage through Hormuz. The strait was now a free fire zone. Beijing's response was immediate and sharp. Diplomatic fury, emergency calls, and a sudden reassessment by Chinese state shipping companies about whether to keep their vessels in the Gulf at all. This is incredibly dangerous, because if China pulls its tanker capacity from Hormuz transits, the volume of available shipping for Gulf crude collapses even further. The world's largest oil importer and the world's most critical oil export corridor are now in direct conflict, and nobody has a clean answer for how that resolves. Now here is where the story gets more complicated, because Hormuz does not exist in isolation. Since late 2023, Houthi forces in Yemen have been attacking commercial vessels in the Red Sea, forcing container lines and tankers to reroute around the Cape of Good Hope at the southern tip of Africa. That reroute adds 7 to 14 extra days to an Asia-Europe voyage, burns an additional $500,000 to $2 million in fuel per trip, and effectively removes around 10 to 15% of global container shipping capacity from rotation, because the same ships are spending more time at sea and making fewer annual round trips. The industry absorbed that hit. Rates spiked, schedules stretched, and the Cape of Good Hope became the default route again for the first time since the 1970s. But the system adapted because Hormuz was still open. Now both are under pressure simultaneously, and that changes everything. The slack that allowed the industry to absorb the Red Sea crisis is gone. There is no backup route for Hormuz oil. You cannot reroute a supertanker carrying Gulf crude around the Cape of Good Hope in any commercially viable way. The distances and fuel costs make it essentially impossible at scale. This is the double chokepoint trap. When Suez and Hormuz are both compromised at the same time, the global shipping system has no more buffers left to absorb the shock. Let me give you a sense of scale here. During the Red Sea crisis alone, the detour around Africa added an estimated $2 billion in additional routing costs to global container shipping in under a year. That was one choke point under partial threat. Hormuz carries 4 times the oil volume of Suez. The numbers do not get smaller from here. So what happens next? The story doesn't end there. There are really three scenarios playing out in parallel right now. In the first, naval escorts return, the way the US Navy reflagged and protected Kuwaiti tankers during the 1980s tanker war, when Iran and Iraq attacked over 450 merchant vessels and the strait stayed functionally open through sheer military presence. That scenario keeps oil moving, but at drastically higher cost, with war risk premiums and freight rates staying elevated for months or years. In the second scenario, the attacks continue in rolling waves, enough to keep insurance markets nervous and tanker traffic stop-start, but not enough to trigger a full naval response. That is arguably the most damaging scenario for global trade, because it creates permanent uncertainty. Shipping lines can plan around a closed strait. They cannot easily plan around a strait that might be open on Tuesday and mined by Thursday. In the third scenario, the one analysts are quietly calling the Black Swan, Hormuz closes for weeks. Some scenario modeling puts oil at $150 to $200 per barrel within 30 days of a sustained closure. Global recession risk goes from theoretical to probable. By 2030, analysts expect Gulf producers to have expanded pipeline bypass capacity, but even optimistic projections only get that to 10 to 12 million barrels per day, still well short of the 20 million that currently flows through the strait. The geography does not change. The dependency does not disappear. And Iran's willingness to use the strait as a pressure valve against the US, against Israel, and apparently even against China is no longer theoretical. Until the underlying conflict resolves, the weird truth remains: the most important 21 miles of water on Earth are also the most dangerous. Next time you see a supertanker on the news, anchored and going nowhere off the coast of the UAE, remember, that ship is not stuck because of politics or headlines. It is stuck because one phone call from a London insurance desk made a $100 million vessel commercially unsaleable, and behind it, 13 million barrels of oil with nowhere to go. That is modern energy shipping, invisible, interdependent, and far more fragile than the world assumes. A 2-mile lane in the Persian Gulf should not be able to hold the global economy hostage. But it can. And right now, it is.